We hear professionals saying we use data to guide where we buy all the time. But data is not a strategy and should not be used when buying property unless you have the ability to analyze it and draw conclusions that indicate sustainable growth and momentum. Data is not a strategy, and confusing the two is one of the most expensive mistakes I see experienced property investors make. We are living in a golden age of property data. Median prices by suburb, by quarter, by property type, rental yield, vacancy rates, days on market, clearance rates, infrastructure pipeline maps, population projections, employment concentration indices, all of it available, most of it free, and a lot of it in real time. And yet, the decision quality of property investors may not have improved proportionally to the improvement in data accessibility. Why? In this video, I want to spend time working through that question seriously because I think the answer reveals something important about how investment decisions actually get made well and how they often get made badly, even by people who are doing all the right surface level things. Let's start with what data is actually good at. Data is good at describing what has happened. Median price growth over the past 5 years tells you what the market did over that period. Rental yield data tells you what the income to price ratio looked like at a point in time. Vacancy rate data tells you what the proportion of empty rental properties was when that snapshot was measured. Data is reasonable at identifying patterns. If you look at historical data across multiple market cycles, you can identify patterns that tend to correlate with various market conditions. Though correlation and causation are different things, and the patterns don't always hold predictably. What data is poor at is explaining the underlying structural conditions that produce the pattern. It describes the outcome, but not the mechanism. And it's the mechanism that actually predicts future behavior. Here's a concrete example. You look at data from a regional city, and you see strong median price growth over the past 3 years. The data is accurate. The prices did grow. What the data doesn't tell you is why did prices grow? Was it because structural demand indicators improved? More jobs, more diverse employment, genuine population growth? Or was it because a one off project drove temporary in migration that's now ending? Or was it because East Coast investors entered the market during a period of FOMO and drove prices above the level that local fundamentals actually support? Each of those explanations produces different expectations about future performance. But the data, median price growth over 3 years, is identical across all three scenarios. You can't distinguish between them from the data point itself. This is the core problem. Data tells you the score. It doesn't tell you why the score is what it is. And for investment decisions, the why is more important than the score. Now, let me be clear. I'm not arguing against using data. Data is essential. It's the starting point for any serious market analysis. What I'm arguing is that data is not sufficient by itself. It requires a framework of analytical questions to interpret it correctly. The channels I find genuinely useful in this space, and there are some doing serious work, are the ones that don't just present data but interrogate it. They ask, given this data, what are the plausible explanations? Which explanations have the strongest evidence? What would we expect to see if explanation A were correct versus explanation B? That kind of analysis is substantively harder than presenting numbers by itself, and it's where genuine insight lives. What does that framework look like in practice? When I look at market data, my first question is always what structural demand conditions underlie this number? Not is the number good or bad, but what's producing it, and is that production sustainable? If vacancy rates are low, I want to understand why. Is it because tenant demand has genuinely grown due to structural employment factors? Is it because supply has been constrained? Or is it a transient tightening that will resolve as new supply comes online? The vacancy rate number is the same regardless of which of those explanations is correct. If median prices have grown significantly, I want to understand what drove it. Is land genuinely scarce here? Is employment genuinely strong? Did investor sentiment run ahead of fundamentals? The growth number is same regardless. If rental yields look attractive, I want to understand what the income profile of the tenant market looks like. Strong yields in a market with low incomes and high unemployment might not be as durable as the headline figure suggests. The analytical framework we use at OV Property Buyers is built around those questions, asking the mechanism behind the data, not just describing the data itself. If you want to understand how we apply that when helping our clients, reach out via the link in description for a discovery call. Here's the second problem with data-driven investing, which is related to the first but distinct. Data is broadly available, which means the patterns that are visible in data are visible to everyone. If a suburb shows strong growth matrix, those matrix are generating the same signal for every investor and commentator in the market. The result is that opportunities that are clearly visible in the data tend to be competed for heavily, which often means they get priced to reflect their attractiveness before you get there. True investment edge, the kind that produces above median returns over time, tends to come from identifying conditions that aren't fully captured in the widely available data yet. That means having better analytical frameworks, deeper local market knowledge, or faster access to primary data sources. It doesn't come from looking at the same data everyone else is looking at and drawing the same conclusion. This isn't an argument against research. It's argument for research that goes deeper than the surface level data that everyone else is consuming. The practical implication is if your investment decision is primarily based on widely available data, suburb median prices, broad yield figures, high level vacancy rates, you're working with information that's potentially already fully priced into the market. To make consistently good decisions, you need the analytical layer underneath that data, the structural explanations, the mechanism. That's a higher bar than I looked at the data and it looked good. But it's the bar that separates a deliberate investment strategy from an information driven guess. Let me close with a concrete suggestion. Next time you're evaluating a market, pick one positive data point that's attracting your interest, say strong rental yield or price growth over the past 3 years. Then ask yourself, what are the three most plausible explanations for this data point? And for each explanation, what would you expect to see in the data and on the ground if that explanation were correct? Run that exercise honestly. You might find that one of the explanations is structural and durable. You might find that one of them is cyclical and at risk. The discipline of asking the question rather than just accepting the data point as a positive signal is the beginning of genuine analysis.